Last week was our first playoff game, and my plaque psoriasis was so itchy under all my gear. Sometimes just thinking about scratching could take me out of the moment. And then my doctor told me I could get clearer skin with a pill called Otezla.
Otezla Apremilast is a prescription medicine used to treat adult patients with plaque psoriasis for whom phototherapy or systemic therapy is appropriate. Otezla can help you get clearer skin after just 4 months.
Okay, ready for the next game. Talking to my doctor about a pill was a total game changer.
Don't use Otezla if you're allergic to it. Get medical help right away if you have trouble breathing or swallowing, swelling of the face, lips, tongue, throat, or arms. Severe diarrhea, nausea or vomiting, depression, suicidal thoughts, or weight loss can happen. Tell your doctor if any of these occur and if you have a history of depression or suicidal thoughts. Live in the moment. Ask your doctor about Otezla. Call 1-844-4-OTEZLA or visit Otezla.com for prescribing info about cost, and more.
Reality radio for a really great future. We're talking real money.
Real money because real life requires it. Real money as opposed to the fake kind. They're gonna catch you if you're counterfeiting money. I'm just telling you right up front. The Secret Service is good, so only deal with real money. That's the theme of our show, no counterfeiting. Hi, I'm Don. Over there is Tom. Our number is 855-935-TALK, 855-935-8255 to talk about what? Not counterfeiting money. That's the topic for today. Do not counterfeit money.
2 hours on that?
Money.
Okay. That's an extensive look at that topic, but I'm down for that, but okay, sure.
It's funny. Our money, I can see why people counterfeit our money. It still looks pretty easy. When I was in New Zealand, their money, I don't know
fancier.
How you...
Yeah, it is fancier.
And it's see-through in places.
Right, yeah.
I mean, you can look right through the bill.
Okay, but who has money anymore anyway? I mean, I'm just looking at my wallet.
I
have a whopping $31 in my wallet. I don't have any money.
I mean, I have a little. No, right. People don't use money. They use, actually,
cards.
I use cards, or I'm using the phone a lot.
Yeah, you've got your Apple.
I've got my Apple Pay, and
right.
I use it I use it as often as I can. Here's a place where I wish they had more Apple Pay. Gas pumps. That would make life a whole lot easier.
Is it a lot of trouble to put your card in and all that? Oh, come on.
Well, I have to, sometimes when I'm driving, sometimes I take my wallet out of my pocket.
You need to go to Oregon more often where they do it for you, I guess, huh? Okay.
Do they do it in Oregon for you?
Uh-huh. Yeah,
it's like New Jersey.
It's state law, yeah.
I was in New Jersey, and you can't. I started to get out of the car, and the guy goes, "No, get back in your car, sir." I went,
"Wait a minute, sit down."
Did I violate a law? Yes, sir. You nearly pumped your own gas,
yes,
darn it.
That's right up there with shoplifting and other criminal offenses.
And then I looked at him, I went, no wonder it's so damned expensive in New Jersey.
Yeah, I mean, there's a cost to having all that, right. Well, it's pretty expensive here. I think I just paid $3.25 the other day.
Oh, my gosh, yeah. Here in Florida, you ready? I just was down the street getting lunch.
I'm going to feel bad, so go ahead.
I looked up at the racetrack station across the street, looked up $2.75.
I'm paying 50 cents a gallon for the pleasure of. Well, we have a very high gasoline tax here. I know that, among the highest in the country, if not
certainly
the highest.
reflected in the free flowing. It's certainly reflected in the free flowing traffic in the area.
Oh yeah, it's just every day those roads you just go right on down there.
It's like in Florida. Okay, yeah, in the Orlando area, we do have traffic jams on weekdays, folks. Monday through Friday.
And we only have them between about 4 a.m. and midnight here. There's a period overnight where there generally are no traffic jams.
I was just listening to the traffic report. It's like, roads are a nightmare, and it's Saturday. Go figure.
Coming down here was a bit of an adventure, yes. So I'm waiting for the day that you hook up the zip line from the office to here. That's what I want.
No. Nope. No, I've got a better idea.
Oh, you're going to put me in one of those automatic taxi cabs with no driver?
I put in a call to Elon Musk. He's bringing the boring thing up.
He'll just right under Lake Washington, right there.
Right, you got to just go really deep. You go. Yeah. It's a downhill, uphill trip. But
please,
well, you read about Musk wants to dig a tunnel along the 405.
I thought he already was, or something.
He's building a short one. It's a couple of miles long, and it's done. It's not
like the big dig or the thing we have here that takes years and
No, it's
everything
like 6
breaks.
weeks.
Yeah, there's just a whole
6 weeks. He
thing.
went,
Yeah,
I'll send my borer down. He punches a button. The machine starts up. He goes downstairs, checks it out a few months later. I have a tunnel.
Yeah, we're halfway to Japan. So, we could use a few more of those here. Sure.
We need more Elon Musks.
However, will go on a limb and say I will not get in one of those autonomous flying taxi cabs that they're talking about. No, I will not do it. That will whisk you along at 250 miles an hour. I would be crying and screaming for the entire what would be 2-minute trip to my office, but still.
That's the difference between me and you. I'd be all over that. Matter of fact, when I was in New Zealand, I said to my wife, honey, this is like the bungee jumping capital of the world. They have a building in Auckland you can jump off of.
Okay.
And all these gorges. I said, I want to bungee jump. I've never bungee jumped. She goes, no, you're not bungee jumping. And then I remembered.
Now, that's the difference between your spouse and mine. Mine would have me right up there and hook the thing to my ankle. Go.
Yeah, but then I remembered when we got the Keyman insurance on me for the company.
Uh-oh.
It said in there
it
that
does
I would
have
not,
that, doesn't it? Yeah.
It has the no bungee jumping or skydiving clause.
And it also has the no taking on insurance agents clause in there. You're going to read carefully because you are in total and complete violation of policy.
I am in default, and I will be. We want to here's the deal. We want to talk about how money affects you and how you can have more of it in your future, how to make investing make sense. 855-935-TALK is our number. That's 855-935-8255.
Tom and Don are talking real money.
Keeping the podcast breaks as painless as possible is my goal. That's why I want to very quickly tell you about the only magazine I've ever heard of that is 100% real investing all the time. There's no business news, no speculative advice, and certainly no lifestyle stuff. It's called Real Investing Journal. I publish it every quarter, and you can get 2 full years for only $25 at realinvestingjournal.com. That's realinvestingjournal.com.
Your guides to a really great financial future. Tom and Don are talking real money.
And here's that phone number for you again to call us on the show to ask questions about your dough. 855-935-TALK, 855-935-8255. I'm Don. That's Tom. We're talking about life and money and how you can make more of it and give less to the people who really don't deserve it. And those are generally the people giving you ridiculous, stupid advice. And we're going to talk a little bit more about ridiculous, stupid investing concepts and advice with a follow-up. I know last week there was a lot of people were really interested in the Seattle pension debacle.
Yeah, you have to say when you're $1 billion short on a $2.5 billion pension that only made 4% a year for a long period of time, that's pretty much a debacle. Yeah.
Yeah, that's a débloqué.
Yeah. Mm-hmm. So we'll give you an update on that and look at some more numbers there that you may find interesting. I think you will.
There's even, oh my gosh. All right, 855-935-TALK's our phone number. But first, it's time to talk to Patrick. Patrick, welcome to Talking Real Money.
Thank you.
What's up?
I worked for Kmart for 25 years, and I have a retirement plan with them. And of course, Sears bought out Kmart, and I received a statement where they want to do a one-time buyout of my retirement plan, and they're offering me $94,000 as a buyout, but my monthly benefit, which I would be available to withdraw in 2 years, is $535 a month. So I'm trying to decide.
So somewhere around $6,000 a month.
Yeah. Now is that single or
$6,000
a year? Is that single life or is that a joint life? Is that just on you?
It's just on me.
Okay,
Yeah.
so
Just on you. Okay.
I mean, this is always a trade-off because. And how old are you? Yeah, we do. How old are you, Patrick?
I'm 63 now, and I'm eligible to start taking the retirement at 65.
I mean, one part of this that I would certainly consider, and I'm not going to say anything bad about Kmart or Sears, but you've seen where they've gone the last few years. The news has not been positive. So that's something to consider when you want to just annuitize the money and get a regular check from their retirement plan. I'm not trying to throw dispersions here, but you can type in Sears on the internet and read an awful lot about the hedge fund guy who's had a little trouble operating a company. That's one thing to consider.
Eddie Lampert?
Yeah, that would be the name. Then the other part of all of this, really it comes down to this. For most people, are you willing to take the $94,000, invest it? You gotta expose it, some of it to stocks and bonds to get some growth, and there's going to be some volatility, right? Things will go up and they will go down. Or conversely, just say, you know what, I'd rather not deal with that. I'd rather just get the $535 check and know, by the way, that in 10 years, that $535 check is worth a lot less. And in 25 years, because you're still a relatively young person, that $500 will actually be worth about half of what it is today, the buying value because of inflation. So that's the trade-off here. There isn't a right or wrong answer, which I wish there was. Don's got his hand up. Maybe he finally has it. He found it.
I think, and again, this is an opinion. I have never sat down and read through the disclosure documents on their pension plan to see how liquid it is and what assets they own in that.
Yeah, right.
Yeah, how well funded it is. And, I know in some cases, in fact, I know at one point in the past, and bear in mind, this is from an old Sears, Roebuck and Company employee for many years. And actually, it was Kmart that bought Sears and then changed the name to Sears Holdings.
Yes,
it was
correct.
Backward. But as one who remembers the pension plan from the days of old, I don't know how it is today, but I do remember back then it was heavily invested in Sears stock.
Which would not be a positive thing today,
if a company
obviously.
goes out of, if the company, which it will, let me just predict something. I rarely predict anything. One way or another, Sears is going bankrupt. Eddie Lampert is draining the assets off, and there's just no way it can survive as a retailer. It just can't do it. There's no turnaround in the cards.
They may take some of the products they produce and sell those other places.
Oh, well, like they're doing with Amazon and
with
Die Hard,
and
Craftsman and Kenmore, and these are great brands from the past. I used to work in the stove department. We were very proud of our Kenmore stoves.
Yeah, they caught you smoking back there in the stove department, I think, or something. So anyway, does that help? I mean, does that help, Patrick?
I got to tell you, if
I would take the money, but that's me.
I would absolutely take the money, particularly in this case. In other cases, it's a toss-up. But bear in mind, Patrick, if you take that $94,000 and you invest it taking a little bit of risk, and I don't mean a lot, I mean like a 30-70 portfolio.
Even 50, half in stocks, half in bonds.
My belief is, based on past performance, that you would have no difficulty whatsoever pulling $400 a month off of that today and still keeping your principal for the rest of your life.
I see. Okay.
Okay.
Well, I have a 401k with another previous employer.
Yes.
Can I roll that $94,000 directly into that 401k?
You should be able to. It's qualified money.
It's both qualified.
I think it is. Isn't it qualified money? Pretty sure.
So you could take the old plan and put it. Let's see. So you would get a
because you can put it in an IRA.
You're not working there anymore, so you're not part of the plan. It is qualified, so you'd just be taking money from a pension plan, putting it into a 401k. Don't see that a lot, but
now I also have an IRA with my credit union. I mean, I could roll it into that too, but the thing with my IRA, it doesn't really pay much in the way of interest.
Really? Let's talk about that for a moment. This is kind of important, Patrick. Why do you have an IRA at your credit union?
Well, when I originally left Kmart, I took my savings and I just put it into an IRA for a nest egg for the future. Mm-hmm. But
how much is in it?
There's like $56,000 in it.
Wow.
You got a lot of moving parts. I mean, the one thing I would like to see you do is clean this up a bit, especially as you head into your mid-60s, so you have one retirement account that pays you the income you're going to need.
How much is in your 401k?
That 401k is, I think it's $56,000.
Okay, so we got 100,000, and then you'd have 94,000. So you'd have over $200,000 in your retirement accounts if you took that cash out. I love Tom's advice. I think that unless you're 401, it's no longer a 401k in which you're participating, so you don't get any matching. If it's like most 401ks, the investment options are probably mediocre at best. I believe that if you get a little knowledge around this whole process of really investing, what we call real investing, you could build a portfolio that would be more diversified than what you have, that would have far better prospects for the future than what you have, and would probably have a level of volatility and should have a level of volatility with which you're very comfortable because you're going to create it based on your volatility. So I think you need to start. And you don't have to do it tomorrow. There's no hurry. You've taken the best first step, and that's listening to this show. You need to get educated. You need to get a better understanding of how investing works. You need to then create a portfolio based on your risk tolerance, move them all into one thing so that you don't have all these disparate pieces. In other words, a hodgepodge portfolio. I think you're on the right track, but you need to make some changes. Good luck, Patrick. Thanks for calling.
Tom and Don are talking real money.
If you need help allocating your retirement plan at work, you can get free help at 401-411.com. That's 401-411.com.
For your real life and real future, Tom and Don are talking real money.
Here's our number once again, 855-935-TALK, 855-935-8255.
Just so glad you're here today because I was worried you might not be. Yeah, I woke up to I was like, will Don be there? Will he be at the wedding? So I was glad when I reached you on the phone and you're here. It's great.
I wasn't invited.
I was invited to a wedding today, not that wedding, but a wedding today. Funny.
So funny. My wife likes watching that kind of stuff.
Yeah, I know she does.
It's a
great.
very
apparently a lot
feminine
of other
pursuit.
people do because they run it a lot on television.
If you look though, and this is not sexist, there is a difference between men and women. If you looked at I was down there reading the paper when she turned it on, and the crowd is the crowd outside. A lot of women. It's a lot of women. And it was funny, last night my daughter came back from a trip to the beach after she graduated college, and Debbie said, "You want to come over and watch the royal wedding with me tomorrow?" And Tori went, "No."
Oh, that must have been disappointing.
And then, Debbie goes, "Why not?" She goes, "I don't like watching weddings of people I don't know."
Wow.
Which made so much sense.
It does, but
I don't
apparently
know
not
them.
True. Yeah, I mean,
why do I want to watch them?
I guess, okay.
I mean, if I got invited, I would have gone probably because the party would be cool. But that's really the only reason. Oh, yeah, and say hi to George Clooney.
Because he looked very dapper, I got to say.
Oh, he always does. Amazing.
Before we get to the pension thing, go. Yeah, because we have another caller.
No, I know.
So we'll
I'm
go to
going
him,
there.
and then we'll get the pension.
855-935-TALK. Our number 855-935-8255. I didn't promise them the pension story at any particular time. I just said stick
tale,
around.
Though you don't want to miss this. It just gets better.
Which means you can't go run those errands you wanted to run.
You know the fun thing I love about
stuck in the car.
I love about the pension story is all of your comments at the. And we got to give the Seattle Times. It's their watchdog piece. They did all the work. We simply talk about it.
We just talk about it.
And all of you that have written in, the majority of people have said, "What? Why don't you just use index funds?"
That's what
we'll
we're
talk
going to
about
get to.
that. Yeah,
Don't.
I'm sorry. I'm spoiler.
You over tease.
I get that a lot. Yes. Okay.
Yeah, apparently. I'm calling. Hey, Dee Dee, does he over tease? Yes, he does. 85. Her voice is not that deep.
Yeah,
it's not,
I know.
Yes, he does.
As a rule, I try not to go out. Anyway, that's a whole other story.
Go out with women with really deep voices.
Too much.
Like the character in Monsters, Inc.
Exactly. Not going to do it.
Wisnowski, or whatever the hell his name was. All right, 855-935-TALK's the number. Brian, you're up next. Welcome to Talking Real Money.
Gentlemen, thank you for having me. I called in a while ago and talked with you about rolling some money away from D.A. Davidson and joked about buying your indexed annuities. I'm just calling back to...
Did you get those indexed annuities we sold you?
That's only on Sundays, by the way, never on Saturdays.
Great deal, yeah. No, we moved... I have two questions for you today. We moved over my wife and I moved over our IRA and our Roth IRA. So So there are 4 total moves that we made over to Vanguard. And looking at the regulations, I'm thinking I don't think I made a mistake, but what I see here on the IRS site is only one rollover per year. And all they did was make a single rollover per IRA for each of us and Roth. I think I'm within their rule. Is that correct?
You're fine.
You're fine.
You're
Yeah.
fine. It's
Okay.
one rollover per year per account.
Per account.
And by the way, did you roll them or did you transfer them?
Yeah, that's a whole different thing.
Well, that's a good question. I think
Because you know the answer. Did you take a check from the previous?
No, this was
that
all
you did
done
not
by
do
Vanguard
a
for me
rollover
on my behalf.
The whole
You
point
did
of
not-
that, the whole point
you
of
did
that
a
rule,
transfer.
they don't want people defrauding the government, not paying the taxes they need. So there's other than that, there's nothing involved.
Okay.
No.
Then I think then you're right. I fit within that correctly. But my second question, my last one here is, we talked about fees last time, the bolt-on fees of the fund fees, and then my investor or my advisor fees. After the transfer of my wife's IRA account, the sale of those funds, I was hoping to stay above the $1,000 threshold for this small little account, but it dropped below $1,000. What I would have done was chosen a targeted Vanguard fund, which is their minimum for $1,000. But now that I'm below $1,000, I think what I'm going to do is take and just roll this over into a Roth. I realize I have other tax situations for myself to
I think that's a good idea.
Yeah.
Why not pay the hit? It's a small amount. Put it in the Roth. Let it grow. I think that's good, Brian.
It's a tiny amount.
Yep.
Good choice. Thanks for the call. 855-935-TALK is our number.
Tom and Don are talking real money.
All right, let's get this break out of the way really quickly. If you're looking for an investment advisor, you need a fee-only, 100% fiduciary, low-cost, science-based advisor. And that describes Vestory. If you'd like to learn more about us, it's really easy. Go to Vestory.com, Vestory.com, or give us a call at 800-386-3004, 800-386-3004. There, that wasn't so bad.
Reality radio for a really great future. We're talking real money.
Only because money is probably the most important thing you deal with on a daily basis, whether it's earning it, saving it, spending it, and we hope investing it. You're dealing with it a lot, and we're here to help you deal with it, particularly the part about investing, which is the area where you have the most trouble. You're probably pretty good at spending it. I'm guessing you're pretty good at spending it.
That's not always true, because we have a lot of people who come in our office who have been savers and they have a hard time spending. So that's not.
But they're
always
in
true.
the minority,
Yes,
I think, in
that's
America.
True. Yeah, that's true. Yeah. Okay. All right.
Yeah.
Fair enough.
It's easy to spend, hard to save, really hard to invest because most of the information you get, as you'll see when we talk about pensions, stinks to high heaven. 855-935-TALK is the phone number, and I can say that most of the investing advice in America is awful. It smells bad. Not literally, figuratively. 855
I don't know. Pile it all up. It might.
935-TALK's the number. Josh, it's your turn. Welcome to Talking Real Money.
Hey, how you guys doing?
Good. How are we? How are you, sir? How can we help you?
How are we?
How are we? We're okay.
We're fine.
I'm good. I'm kind of playing around with maybe leaving my job and taking a year off. If I'm not going to have any income coming in and thus not having anything going into my retirement, I'm kind of wondering what I should do with my 401k.
How big is it?
It's at about 90,000.
It's about 6 inches tall. About that big.
Yeah, it's a lot of paper there. That's a
I
lot
just
of
got
fun.
time.
How old are you, Josh?
I'm 29.
Gee,
you're a young guy. Good for you.
He's
good
a
saving.
smart young guy.
Yeah, that's good.
I'm doing about 20%, and about 60% is high risk, and 40% is target date. So I don't know if I should play with that or what I should do.
Different. You're asking two different questions. First of all, do I think it would be a good idea when you have no income to take a substantial amount of the pre-tax savings you have and moving that into a Roth would be a very good idea, because on most of it, you will not pay income tax depending on other situation in your life. That makes a great deal of sense.
Yeah.
Okay.
And you're going to need to do some modeling around that, because to make sure that you do not pay tax. So you'd have to look at the tax tables and figure out how much you could take from one to the other without jumping into the next bracket and paying tax. That is a brilliant idea. Then to the second part, at 29, most of you before age 30 should own almost no bonds, maybe zero. I just looked this up today because we're going to talk about interest rates if we get time. The Vanguard Total Bond Fund is yielding 2.5%, which is a lot more than it did 4 or 5 years ago.
But basically, he said he has high risk and target date, and I guarantee a target date at his age is almost 100% equities. It's probably 80 or 90.
80-20 is my guess. Yeah. But then when you say high risk, does that mean all the rest of it is in stocks?
I go through my works. I go through T. Rowe Price. And I called them up, and they said high risk. I told them I wanted high risk. They said they put it in a high risk. It's yielding, I think I've got like 6% last month on it somehow.
Okay, now I'm getting nervous because I don't know anything that made 6% in the month of April. But that aside, I mean, are you going to go back to this firm when you take your come back from your year? Okay.
I absolutely plan on it.
Okay. Then I'd leave the money there. Yeah. Mm-hmm. And I would
just leave it in
and move it from the. Now, can you do that in the plan? That's a different measure. I don't know if you can while your money is still in the 401k go from pre-tax to Roth.
I bet he can. Well, he should check because he may be able to. A plan can allow him to go from a pre-tax to a Roth within the plan, but it's really up to the plan.
You need to check with your human rights department then.
Yeah,
okay,
I'm looking at T. Rowe Price's funds, and I'm looking back a month, and I cannot find a single T. Rowe Price fund that did 6% in the last month. So
anyway, that makes but do I think you should be 100% in a stock portfolio? Yes, especially if you could take the ups and downs, because at 29, owning bonds, it's not the best advice generally.
What are you going to do for a year, Josh?
Yeah.
I was looking at hiking the Continental Divide for some months, 5 months, and maybe
wait a minute. Have you done an easier long distance trail than
Don wanted to do the Appalachian Trail first. I said you might want to just go around the state park first to see how it is.
I mean, I'm a Coloradan. I don't know that would be where I'd start.
No, I've done some hikes, but nothing of that size. But
good for you.
But yeah,
good for you.
I think it'd be great.
And
I think it'd be awesome.
You're still single, then I take it.
Oh, yes, sir.
Okay, I was going to say because.
This is the time.
I agree. Get out and do it. That's great. Yeah.
Boy, I'm so.
If I wasn't single going into it, I'm sure I'd be single after it. So.
And you're a smart guy too. I like that. Yeah. No, I'd go ahead and move. Ask the plan. See if you can move money from the pre-tax to the Roth. Go as high risk as you possibly can. Leave the money there and take off on your hike. That'd be my advice.
Your high risk portfolio for your high risk hike.
Exactly.
At about as high an elevation as you can get. Take oxygen. 855-935-TALK's the number.
Tom and Don are talking real money.
In addition to the Talking Real Money podcast, I also do another podcast that's very popular over at Apple Podcasts. It's called Money 30. Every day I try to educate and inform you about money in a brief 2 to 4 minute podcast. So check them out at Apple Podcasts or all the other podcast services or at money30.com.
Your guides to a really great financial future. Tom and Don are talking real money.
Real money, real life, and occasionally real stupidity. Well, last week we talked a little bit about a story in the Seattle Times, a very in-depth piece of economic journalism.
Yeah, by their watchdog group. It was really a great... I mean, if you want to know about this industry or know about the people managing your money that you think are taking care of, well, they're taking care of it, maybe just not taking care of it well. That's a great piece. I mean,
no, they're taking care of themselves.
Yeah, boy, they've done that. I mean, and so we talked about this last week. The Seattle pension is $1 billion underwater. I mean, eventually that money has to come from somewhere.
This is for city employees.
Correct.
In Seattle.
Yeah, these are folks that have worked for the city of Seattle and expecting to get their check, rightfully so. That's what they signed up for. And the fund has returned 4.1% a year. It's among the worst performing pensions in the country for a variety of reasons.
Over what period again?
I think that was 10 years. 10 years.
All right.
And there's a variety of reasons for all of that. But so a great article. And the thing that I loved on is that then people wrote in, a lot of people. I was glad to see so many people sort of involved in all this. And a lot of them said, why don't you just use index mutual funds?
Well, and for good reason, because index funds, certainly, I can't find one that over 10 years did anywhere near 4%. They all did. They're mindless funds that beat the tar out of that.
You're typing in mindless funds to see what comes up?
Mindless funds, yeah. No,
My picture's
actually,
not
what
there.
I was doing? I was putting in the DFA Global, which is a fund that they could get their hands on, which is a fund we like. I mean, they could get a global type product from DFA. I just want to see how that did over 10 years. Over 10 years, the DFA Global Equity Portfolio, institutional, did 7% per year.
Yeah. So,
which is a substantial increase at a fraction of what they spend to manage their fund.
We talked about other pension, Harvard that spent over $200 million on consultants over a 4-year period. It's ridiculous. But then the response, so all these people wrote, and then the Seattle Times took a lot of those responses and went back to the folks at the Seattle Pension and said, here's what people have said. For example, a lot of people said, why not just own index mutual funds? And this is where I really struggle. Rather than just saying, you're right, we should fix it, they said, well,
no, they argued.
They argued. They said, well, we do have a third of the money in index funds, but the other parts, I guess that's 2/3, are in actively managed funds because where we can find market inefficiencies in places like Brazil, Russia, India, China. And market inefficiency is someplace you can go trade to make more than just being in the index. We do that.
That's the argument active. That's the argument every active manager uses is this. Yes, some markets are efficient. Large caps, they're efficient. But smaller markets, they're less efficiently priced. So an active manager has an advantage over the inactive index fund. And so I wanted to check that argument out. That emerging markets, he mentioned that specifically, emerging markets create the potential to beat the market. Now, the Seattle Pension has $2.5 billion in it, which
it should have dwarfed, 3.5, by the way.
Which is dwarfed, though, by the likes of Fidelity or American Funds or T. Rowe Price. These companies manage hundreds of billions of dollars, and they do all of them have actively managed emerging markets funds.
That is where a manager is picking stocks or timing markets or overweighting to a particular country over another, something like that.
So I decided to look Fidelity because they're one of the largest, American Funds, New World Fund, because it was rated among the top by Morningstar last year. A 2017 article, they picked it as one of their top rated funds, and another they picked as a top rated was T. Rowe Price Emerging Markets. Now, Fidelity's Emerging Markets is a no-load fund. Americans is a loaded fund unless you use the Class C shares, which means no front load. So I use that. And T. Rowe Price is a no-load fund. Now,
load meaning no commission.
No commission.
You don't pay anything to get into the fund. Got it.
Now, let me give you the 15-year. 15-year, that's as far back as Morningstar goes. 15-year average annual return for those three funds. Fidelity Emerging Markets, 11.87.
Pretty doggone good.
American New World C, 10.31.
Again, pretty good.
T. Rowe Price Emerging Markets, 12.46. Now, you can't look at those in a vacuum, though. How do those look related to the amount of risk they took and the number of stocks in the portfolio and some extra expenses that aren't reflected in those, like trading costs? So one of the things you want to look at is the annual expense ratio. Fidelity Emerging Markets, 0.97%.
A little on the spendy side, sure.
You ain't seen nothing yet.
Oh, pardon me.
American New World C, 1.84%.
Whoa, that sounds like twice as much.
And T. Rowe Price Emerging Markets, 1.23.
Again, that's pretty expensive. Okay.
Now, how about the trading costs? And trading costs, by the way, are not reflected in those expense ratios. The Fidelity Fund has 81% turnover. That means 80% of the portfolio changes every year.
You started with these stocks. You ended up with a completely different set other than the 20%. Yes.
American New World C, 37%, much lower. T. Rowe Price Emerging Markets, 31%, much lower. And the number of stocks in the portfolio is also indicative of the amount of risk you're taking.
You own more stocks, you're taking less risk.
Less
you should
risk.
Be. Correct,
right,
yes.
Right. Fidelity Emerging Markets, 134 stocks.
Pretty limited.
American New World, 357.
Wow.
A little more.
That's why they charge twice as much, apparently.
Right. T. Rowe Price Emerging Markets, 87.
Wow, they are really concentrated.
Then we look at volatility. How bouncy are these funds? Well, the highest yielding, the highest returning of those was the T. Rowe Price Emerging Markets. So obviously it had the highest volatility, 22.86%. It's a number. Just remember the number.
Okay.
Fidelity Emerging Markets, 22.35%. American Funds, which was the lowest returning, had the lowest standard deviation of 16.53%. But I wonder why. It turns out that American New World C is mainly a developed markets fund. In other words, big markets, not emerging.
Okay.
T. Rowe Price has 71% in emerging, and American Funds has less than 50% in emerging. So that makes them less volatile. But here's the rub. I compared it to an index-style product.
Yeah.
The DFA Emerging Markets Fund.
Dimensional funds, yes, which you said earlier people could access. I don't know how they could unless they use an advisor.
The pension could access it.
The pension, that's correct.
The pension could access it.
The public cannot.
They could easily get into DFA funds and save their investors a lot of money.
And a lot of them do, by the way. So you're comparing these actively managed funds to the dimensional funds emerging markets. Go ahead.
Correct.
All right.
The dimensional funds emerging market came in ahead of Fidelity and American in total return, 12.15%, but slightly below T. Rowe Price, which was at 12.46. But the annual expenses, T. Rowe Prices, remember, were 1.23. DFAs are 0.48.
Wow, I didn't know they're under 50 bips. Okay.
Now, the T. Rowe Price Emerging Markets Fund has 87 stocks. The DFA has 1,111 stocks. Their turnover is 4%, and their standard deviation compared to almost 23% at Fidelity is just over 20%, which is substantially less. It's more diversified. It's done really well. It makes no sense not to use equities. It makes no sense except that the companies, the managers get richer.
Talking real money.
We mention 855-935-TALK, 855-935-8255 throughout the podcast. But you need to know that you can call that number 24 hours a day, 7 days a week. Leave your question, and those will be answered in special Talking Real Money podcasts that will appear on this particular site in the future. So give us a call, 855-935-TALK, 855-935-8255.
For your real life and real future, Tom and Don are talking real money.
And if you want to hear more of this show and what we do, go to Apple Podcasts or iHeartRadio or any of those, or TalkingRealMoney.com, and listen to our podcast. These shows become podcasts every week, and I've got another podcast called Money 30 that you can find at Apple Podcasts that is short bits about investing.
We hope you realize that the information provided on Talking Real Money is for educational and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately, consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Vestry, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. Are we done now?